Andrew Freris of BNP Paribas Wealth Management, who joins us on the show from Hong Kong, like we did mention to you. Now, Andrew, to begin with, tell us what the possibility of reformist action from the Indian government in its remaining 2 years of its term could well be.
Well, if one looks at their record in the past 3 years, I'm afraid it's not going to be a very happy one, because there seems to be a continuous to-in and fro, not continuous to-in and fro, in some important issues like the deregulation and the opening up of the retail distribution sector. You know, we said yes and then we said no. And then, of course, there is a very awkward issue with the telecommunication and the licenses, which I imagine legally the High Court revoked now the license, but of course for foreign investors saying, you know, I go in and then I'm never quite sure whether I will be able to get out, or whether once I've been in, you know, what is really going to happen. And of course, to the extent that it is very unlikely that the Congress Party will have an absolute majority and it will rely on coalition, then coalitions are not particularly good for reform action, because you have to please a lot of different sectors and interests. Now, this is it's not a bearish view; it's simply a very, very realistic view.
Right now, Andrew, the latest inflation numbers, the monthly inflation numbers in India have slipped to their lowest in 26 months. Do you see it weakening on a sustainable basis, rather dropping on a sustainable basis to maybe 6.5% to 7% by the end of March?
Well, the numbers were driven down, in fact, by negative food prices, and I'm afraid food prices can tend to be also seasonal, and they may not reflect at all overall pressures of aggregate demand. So, as it is, again, it looks as if inflation is likely to stay with a 6 number in front of it, and that's going to help the Reserve Bank of India to actually start cutting interest rates. The concern is further down the line. If there is any deregulation, particularly on electricity prices, then this may very well reverse it. But then this is going to be a kind of, let's call it administrative or administrate inflation, rather than inflation with the underlying pressure of the economy appearing. So if I was to add all the three considerations together, from my point of view, it is not really the issues of inflation. Will this encourage the Reserve Bank of India to begin to cut? And it looks very likely that it will.
I wanted your view on the Indian rupee and FY13 and the risk to inflation due to a depreciating currency.
One has to keep in mind that India is not really a trading economy, and meaning that both imports and exports play a relatively low role on its GDP structure, and therefore by extension, and particularly in the case of food, where India is almost completely self-sufficient, you know, a weakening rupee is unlikely to have any really significant impact on inflation. The weakness in the rupee we have seen was, of course, primarily capital outflows, and the equity market has been performing very, very strongly. Actually, it is the best performing equity market year to date in Asia. It could reflect a rebound from being the worst performing market in Asia during the last year. So to the extent that capital flows may support the rupee, good. To the extent that they may not, the impact of that on inflation is likely to be very low.
Andrew, wanted to also get your view as to how crucial and critical you think the 2012 budget will be from an economic standpoint, and how much room does the finance minister have to spur growth?
I'm not holding on my breath, unfortunately, because the overall size of the deficit has been increasing, and in a period in which the Reserve Bank of India may be trying to see interest rates coming down, it would be actually tempting to increase a little bit the deficit, because more than about a third, I believe, of all revenues of the central government in India goes towards amortizing and funding the domestic debt. So, you know, we might have mixed news, but as I said at the beginning, the likelihood of significant reform measures being taken is very low indeed. So you could see some tweaking on tax rates, you could see some tweaking on liberalization of parts of the financial sector. But frankly, I'm not going to hold my breath. And quite likely, if we are coming up, of course, for elections, I would not be surprised if the pressure on the deficit is going to be on the upside rather than on the downside.
But Andrew, also India's savings rate has declined to 32.5% of GDP, down from its high, the high that we saw in the financial year of 07-08. Also, the country is witnessing a decline in investment rates in the corporate, in government and savings as well. In light of all of this, do you see a risk of India entering some sort of a structural slowdown, or do you believe that we are only in a cyclical downturn?
The structural slowdown has a much more focused, if you want, area, and that is investment on infrastructure, and particularly road building. So I would be much more concerned, and I would like to see what the government proposes to do in terms of its own infrastructure spending and in terms of what it could try to do in order to encourage infrastructure spending by the private sector, rather than simply being concerned that investment overall is decelerating, because actually growth of investment is effectively decelerating right across Asia, including China. So India is by no means alone here. What I'm much more interested is to see where the investment is decelerating most, and it really shouldn't be on the infrastructure side.